Hey everyone, me Kevin here. In this video, I'm going to explain what happened to me when I used margin to buy Tesla stock. And the result was surprisingly bad. Now, in order to share this story, I'm gonna have to make sure that you've already signed up for your life insurance, so get that in as little as 5 minutes via the link down below. And of course, get a free stock worth up to $1,600 with Webull, as long as you deposit $100. They give you a free stock worth up to $1,600. So with that out of the way, let's get into what the heck happened and what I wanna share with you about margin. The first thing I'm going to do is I'm going to explain what margin is. So if you want to skip the explanation on margin, I'm going to put a time on screen right now and then just skip to that time. So that way we can start talking about what actually happened to me. But if you don't happen to fully understand margin, this is going to be a good explanation for you. Great. Let's get started. First, what is margin? Margin is debt. So think about it this way. And I'm gonna make an example here that doesn't actually exist in reality, but I'm making this example, just assume it exists, ignore the technicals of this example. Let's say you have a car worth $1,000. You use it to drive to work back and forth every day. Now, you go to a bank and you say, hey, I'd really like a credit card. And they say, well, you know, we don't really have a good credit history with you. How about we use your car as collateral? And we will give you a secured credit card. So that way, if you don't pay off your credit card, we'll just take your car. So now they give you a credit card. What do you have now? Well, you've got a car that's worth $1,000. You've also got a credit card that has the potential of spending $1,000. Let's say you take that $1,000 and go buy gift cards. So $1,000 worth of gift cards. Okay, now you have $2,000 in assets. You have $1,000 in gift cards and a $1,000 car. You basically just doubled the amount of assets you have. Now, the interesting thing is, with secured credit cards, if you don't pay your card on time, because you have a secured credit card, the bank could immediately take some of your assets, in this example, your car, and then use that money to immediately pay off your credit card. Now, I'm oversimplifying because, again, banks don't give you secured cards against your car, but the point here is to say the bank has this hammer that floats over your head. Basically, the bank says, you better pay us, otherwise you're losing your ride. And that hammer can drop, and they can instantly show up with a tow truck and take your car to pay off your car if certain things happen. Well, that secured credit card did let you double your access to assets, which is kind of cool. So, you know, maybe you were thinking, well, if I get all these gift cards, I could do a business and I could start a business or I could make some more money, right? That's why we take on debt, is because we need some more money or we want some more money to go invest more, right? Margin is very, very similar, except rather than a bank or, you know, a secured credit card and $1,000 car, let's pretend now you have $1,000 in Tesla stock. That's your car. Now, instead of a credit card, you have something called a margin account. Think of it like a margin credit card. And instead of buying gift cards, you just go YOLO and buy another $1,000 worth of Tesla stock. Great. Well, now you have your original $1,000 worth of Tesla stock. Plus, you just borrowed another $1,000 to buy Tesla stock. Now you have $2,000 of Tesla stock. $1,000 that you own, $1,000 on margin. You have a loan worth $1,000. So you really still have equity of $1,000. But the benefit here is if the market goes up 10%, you gain $200, right? Because you have $2,000. 10% of 2,000, that's 10% return. That's $200. That's awesome. That beats a 10% return on the $1,000 of your own money, which would only be $100. So people use margin to extend their gains. However, leverage works both ways. If prices go down 10%, you lose $200 instead of losing $100. And that's where problems come in. So I made this simple tool. And this simple tool, I'm gonna go ahead and give this a quick explanation here and then we'll actually get into what happened to me. So here's a simple little tool that I made. I made this example here. We'll call it the Robinhood example, all right? Let's say I've got $1,000 worth of Tesla stock. Robinhood lets me borrow 100%. So 100% of what I have is they let me borrow another $1,000. Great. So now if I buy Tesla stock with that extra $1,000, I have invested a total of $2,000. Great. What could possibly go wrong? Now in the fine print, Robinhood's going to tell you that you need to maintain at least 25% equity, which works out to about $500 in equity. Well, what is your equity position on day one? Well, on day one, let's see, you have $2,000 invested, but you have $1,000 worth of debt. So on day one, you have $1,000 in equity. All right, sounds good. But now, what if the stock market falls 40%? Whoops, there we go, 40%. Well, now all of a sudden, a 40% decline in Tesla stock means your $2,000 in stocks just became worth $1,200. Uh-oh, well, wait a minute. You have a minimum equity requirement. See, you have this $1,000 loan, so $2,000 in stock value minus $1,000, uh-oh, that only leaves us with $200 of equity, which means Robinhood goes, uh-oh, your account is negative equity, or you have negative margin equity, a negative margin balance. You are negative $300. And now Robinhood could call you up, literally call you up if they wanted to, but they'll probably email you or send you a notification and say, hey, yo, you owe us at least $300. You can now go sell $300 worth of Tesla stock while it's just lost 40%, or go get some cash out of your bank and get it over here. We'll give you maybe 2 to 3 business days to come up with the money if we feel generous. And if we don't, we'll just sell the stock automatically for you. It's kind of like your car getting repossessed automatically. You have zero control. You just literally signed your rights away to your stocks, and they will sell them at the bottom of the market to cover the $300 you owe them. They will not lose money giving you margin. This is very dangerous. And this is a calculator, so I will give this to you. I made this for M1 Finance as well because they have different equity requirements, and they also only let you borrow up to 35%. You can play with that yourself, though. Again, I'll link that down below. So, all right, here we go. Now we have an understanding of how margin works, and it kind of sucks. In fact, why don't we go ahead and pull up what a Robinhood email looks like? Just take a look at this Robinhood email here on screen, and you could pause and you could see, ooh, yeah, that's not the kind of email that you want to get. So anyway, I'll link that down below. All right, what happened to me? Well, here's what I did. Starting on March 6th, I decided to refinance 4 properties immediately to raise as much cash as I could. And I like real estate debt because the tenants are paying for it. It's 30-year fixed rate lending. And the banks can't sell your real estate if prices go down. This makes real estate very different from margin. When prices go down, as long as the tenants keep paying, I pay my loan, they don't sell my properties. Even if prices go down. If tenants stop paying, in America, you take mortgage forbearance. It's a crazy world. But anyway, I drew down my credit lines and I refinanced 4 properties. These are all real estate loans. And I put them all into accounts at Robinhood and M1 Finance. During March, when things got really bad, towards the end of March, I decided to refinance another 4 properties so that I had as much money as possible flowing into the stock market. And so I bought Tesla like crazy. I bought Apple. I bought Redfin. I bought Amazon. I went nuts buying stocks. I thought to myself, there's no way we're going to see prices this low again. Unfortunately, come April and May, I had balances now and I had stocks now. So I thought, what could go wrong? Let's just start buying on margin. Basically, you get so used to seeing prices go down that you keep convincing yourself, especially during like March and April when it was just like red day after red day, you keep convincing yourself, at least I did at the time, that, hey, things are on sale again. All right. It was painful, don't get me wrong. I made videos of me throwing money into the fireplace, and people were like, Kevin, that's illegal. And I'm like, oh crap, I didn't know that was illegal. But it literally felt like I was throwing money in the fire, and it felt bad. But on the other hand, I kept looking and I'm like, the sales, I just gotta keep buying. So it's like, you just start, now all of a sudden you've gone through all your cash, and now all of a sudden you're using margin to buy and buy and buy, and it's really sticky. You almost forget that you're borrowing money because it's so easy to just swipe up on Robinhood and boom, you've just executed another purchase and you feel good because you're investing. Except it's not really obvious sometimes on Robinhood that your buying power is actually margin. If you have a margin account enabled, you could set limits to it, but we all know we can undo that limit within like 20 seconds. So before I knew it, I had pulled out $300,000 of margin on Webull, $500,000 of margin on Robinhood, and wait for it, $2.9 million of margin on M1 Finance, which worked great while the market was zooming. Insane returns. I mean, amplified returns, right? Well, in July, the tech stocks, in my opinion, started hitting pretty high valuations. I sold out of the recovery sector in May, and then finally again in August, and I stuck only to tech. Except in July, these valuations were starting to get a little stretchy. I had a price target of $3,400 for Amazon in 2022. Well, here we are in 2020, and in August, we hit like $3,500 for Amazon. I'm like, this is ridiculous. No. So in late July and early August, I decided I couldn't justify buying stocks heavily anymore. And instead, I would transition to buying real estate. I told this to all my course members because every day, no matter which course you join, I hold daily live streams when the market is open. And I told all my course members that I'm going to start paying off margin. And you can look, all the live streams are archived if you're in the course. Fortunately, I was paying off debt like crazy. And so come September, I had paid off my Robinhood and my Webull margin, but I had not paid off my M1 Finance margin. Now, generally I recommend do not take margin of more than 20 to 30%. Honestly, probably don't take it at all unless you could pay it off or you have some income stream that you know you're gonna be able to pay this money off with quickly. Well, in September, the market came tumbling down. Fortunately, my Robinhood and my Webull was paid off, but my M1 Finance was not. I was also not, and still am not, very heavily diversified. My view of stocks is that I pick my favorite stocks, my favorite winners, which you could see at metkevin.com/top, or my favorites at metkevin.com/1337V11. You could see it there as well. This is my favorite stocks, and so I like to concentrate in my big winners. And then I diversify with real estate. The problem is when you're using margin, your margin lenders don't care if you've diversified with real estate. When Tesla falls 40%, it falls 40%. And all of a sudden it's like, oh, margin. Yes. So here's what I didn't expect to happen. There are 4 things that happened to me. And I want you to know about this. Because if you're using margin, I guarantee you felt some of these things. And it's normal, but it's bad. If you're not using margin, you gotta be careful of these things because it's gonna happen. Here's the thing. The first thing that happened to me, the fear of a margin call prevented me from shopping more heavily in September when prices were falling. That's really frustrating to me because it's exactly the opposite of what I did in March and April. In March and April, I didn't have margin. I had cash in the bank and I had cash from real estate, and I was comfortable with that cash that I had. And so even though the market was falling, I'm like, discount again, buy, which was the best time to do it. Well, here we are again, prices are falling, but I'm not buying because of this margin, and I'm hesitant to buy heavily, where usually I like to see red in the stock market, but I'm hesitant because I'm like, well, crap, if I keep spending the cash I have, then I don't have cash to pay off margin, and then what if I get a margin call because who knows how far the market's gonna fall? Nobody knows. What if we get a second wave and we get a flu COVID pandemic? I don't know. Anything could happen. Nobody was expecting COVID-19 to do what it did, right? So these things can happen. Margin is just the idea of having margin and the idea of getting a margin call is preventing me from buying the way I would like to. The second thing that happened is when the market is green and you're using margin, and you gotta be really careful of this. You know, I switched in July. I'm like, wait a minute, what's going on here? But you gotta be careful of this. When the market is green, the market's going up, and you're using margin, you're actually more likely to use more margin because there's this loop of margin reinforcement. Everybody on Wall Street's bets, you know, and all your friends are like, look at all this money I'm making. And so you're like, oh, I don't want to FOMO. I got this fear of missing out. I don't want to end up with SOMO, the sadness of having missed out, right? So you end up buying more stocks on margin. Then the next day, stock values go up. And then Robinhood blesses you with more margin available because, well, stocks went up, you just bought more stocks, and so your margin went up because everything's going up and like things can't go down, right? So your brain psychologically learns like a lab rat. Oh yes, green, good. I just buy every day the market is green. This is why I have a rule in my stock course. And I say, do not buy on green days. Buy when the market is red. But when you're using margin, you actually fight buying on red. You're doing the opposite. Margin is making you go, oh, I don't want to buy when it's red because I'm worried about a margin call. Instead, when it's green, you're more likely to buy because they're giving you more margin. They're like, here, have some more money, have some more money. It's like margin is toxic. It's like the worst thing you could do to your psychology. But that's not it. The third thing that happens is you start getting this little devil that sits on your shoulder, and the devil follows you around all day long. You have margin. I can strike you down with my scepter at any time and kill you. Like, it literally feels that way. It's almost like you go to sleep and you're thinking about margin. Like, instead of counting sheep, you're counting margin dollars. And then you start waking up in the middle of the night from nightmares of margin calls. It's like this psychology that happens when things go red and you have margin is the opposite of what you should be doing. You should be buying when things are red, not with margin. So the fourth thing that happens is you're more likely to sell to get the devil off your shoulder. In fact, on September 21st, I decided to liquidate 15% of my portfolio. Even though it was a red day, I sold $1.2 million worth of stocks. Now, I had a lot of gains on these stocks because I stopped buying in July, really. You know, I nibbled. I say nibble in August. I nibbled in August because I kind of just dollar cost average in a little bit. But I didn't heavy buy since July. I haven't had a heavy buy call in a while. But I decided to take out 1.2 million out of the market because that would give me enough cash to completely pay off my margin in one swoop. And I ended up including in that sale $442,000 of Tesla cells. That means I sold $442,000 worth of Tesla. So on Monday, I made a video on YouTube called I Sold, and I explained that I sold 15% of my portfolio, which obviously includes Tesla because a lot of it is Tesla. And I specifically sold because I wanted to A, reduce margin, and B, I want to buy real estate. And I don't feel comfortable buying real estate when I have a ton of margin outstanding, especially when I've got deals closing and I need to raise cash. So I had this two-pronged approach to let's just pay off margin, or at least have the cash to pay off margin. And you know what? Maybe now's a good time to do it anyway, because if you watch my Saturday video about watch this before Battery Day, you'll see that I said if Battery Day misses expectations, Tesla stock is going to fall and it's going to pull down the entire tech market, which is literally what happened. And I'm not trying to pat myself on the back on that. I'm not saying like I'm a prophet or whatever. I just planned for that potential. If Tesla bombs, it's gonna bomb tech. It just consistently happens. And so that's why on Monday, the day before Battery Day, I said, let's eliminate margin now, because I'm not gonna carry the devil on Battery Day when there's a good chance expectations are gonna miss. After I sold on Monday, like Monday evening, Elon Musk tweets, "Don't get your hopes up about Battery Day, it's a long run play." Yeah, and the stock started tanking. Anyway, this led to some questions about whether or not I actually sold in the comments. There were some commenters leaving comments going, "Oh, sure you sold on Monday before Battery Day. Sure you did, Kevin. I think you're just rewriting history to make a video about it." So what I'm going to do right now is I'm going to pull up my M1 Finance account. It is actually right here. There we go. You can see Kevin Paffrath's M1 Finance account. What we're going to do is we're going to click on this little activity button here. And you can see some withdrawals here. Yesterday, I made a video saying I was buying with some of the money that I had available, and I did. You can see I bought in 1337, 33 buys here. I put $100,000 in, and it bought, all the stocks in 1337. Cool. All right, now if we scroll down to the 21st, which is Monday, you'll see right here, morning trading, and I sold a little bit in the afternoon too. Morning trading, 33 sells for $1.26 million. And if you click on Tesla, you'll see that I put in a sell at $446 for the amount of, it's $452,000. I thought it was $442, but whatever. I sold $452,000 worth of Tesla at a share price of $446. And I did that just because I wanted this cash available to wipe out all of my margin if I needed to, and to buy real estate. Because the cool thing is, now if I have margin available, I can always borrow a little bit of margin. I'm okay doing with that. I can nibble a little bit from my margin and buy real estate. Because the cool thing is, the lenders don't see that as debt. Like, they don't qualify your margin debt as debt when you go to qualify for a home loan, which is like stupid because margin's way riskier. But anyway, like, I'm in a position now where I'm like, oh, the devil is off my shoulder. Because the margin, like, the psychology that happens when things are going good with margin is the opposite of what you should be feeling. And when things are red and discounted, you have the opposite feeling with margin. Margin, bad. And I have consistently said, do not spend more than 30% of your margin. Stay away from the Webull and the Robinhood where you can do 100% margin. Personally, after this experience, I'm going to revise that down to don't use more than 10, definitely not more than 20% margin. And ideally, have some kind of, be in a situation where, like, if you get paid next week, you could take all that money and pay off your margin. Or maybe you have a home equity line of credit where it's like, if you needed to, you could wire the money from the home equity line of credit and pay off your margin. So if that's 5% margin, fine. But honestly, margin sucks. And it is nothing like buying real estate. Because buying real estate, you're getting 30-year fixed rate loans. And I mentioned this earlier. They're not calling you if prices fall. They don't care. They don't care if prices fall in real estate. The value of my real estate could literally half. It could be way upside down. Real estate could fall 60%. It doesn't matter. As long as people are paying rent, I'm good. And if people stop paying rent, I need mortgage forbearance, because that's the world we're in. It's crazy how protected real estate is. Today, it didn't used to be like this in 2007, 2008. It was really bad. It's much better today. But compared to margin's a complete disaster. So right now, I feel good. I feel much better. But this is my margin story and what happened, my take. And hopefully, this helps you stay protected. Because the last thing you want is to make a lot of money and then have to start over. Thanks so much for watching. Check out the courses I have linked down below in that coupon code. And folks, we'll see you next time.